Hello, everybody, and welcome to the Public Podcast. I'm your host, Kinsey Grant, here with you today to discuss a big one, the potential impending recession and, of course, its causes. We're going to have a lot of fun today, despite, talking about a recession. I guarantee it. So if you want, you can feel free to check us out on Spotify at The Public Podcast and YouTube at Public Invest for in-depth interviews to help keep your portfolio on track no matter what comes at you. So today, to talk about the impending recession, its causes, and of course, its potential end, we are super excited to welcome a fantastic guest, Julian Brigden, the co-founder of Macro Intelligence 2 Partners. Julian, welcome to Public. How's it going?
Thank you very much, Kinsey. Very good. Thank you very much.
Well, I am glad to hear it. And I'm excited to have this conversation today. I think anybody who is listening to this podcast probably knows that what counts as a recession, what causes a recession, what ends a recession, these are all major questions that plenty of us are considering right now. So I'm excited to get a little bit more insight and analysis from you so that we can be stronger investors, have a better idea of what's coming, and just talk about what's happening in the macro and micro sense here. So if you're ready, we can jump right in.
Sure. So, I mean, look, how did we end up here? We ended up here because we rather overdid it during COVID. You know, hindsight is 2020, but the reality of the situation is we both eased monetary policy far too easily through a combination of lowering interest rates and pumping, trillions, to use the Austin Powers-esque type phraseology, of money into the system, and then we goosed it even further with a inordinate slice of fiscal stimulus. And that sort of combination, in conjunction with ongoing supply chain problems that we were having because of COVID itself, meant that we had this perfect storm of explosive demand fueled by monetary and fiscal stimulus and constraints on supply. Now, that kicks things off. You get this sort of supply-induced rush up in prices, but there was an underlying aggregate demand situation there, and there still is. So if you look at the level of goods demand, the level of service demand, it's running well above kind of trend. And this clearly left the Fed with a bit of a problem. And, we had similar things in Europe, in the UK as well. And so the central banks have to start to tighten rates. Now, I do think there was an element of we can't get it wrong twice in a row. So having called inflation transitory, we really needed to gird our loins and get going and be tough and bring this thing to heel. And in fact, I want to say it was last summer, it was the end of 2021, where these three central bankers sort of met up in Sintra, which was the ECB's equivalent of their sort of summer offsite in Portugal. And you had Andrew Bailey, the Bank of England guy, Jay Powell, and Christine Lagarde. And they all sat in this press conference and they said, we're determined to bring inflation back into the system, but to bring it out of the system. So how do you do that? You start raising rates, you start tightening the balance sheet or reining in that quantitative easing that you put in. And that's why we've ended up where we've ended up. And if you look at I think one of the things that struck me as quite interesting, Kinsey, is when you sort of start looking at the beginning of the year, we had a lot of talk about no landings, soft landings. And I think essentially people were forgetting that monetary policy works with a lag, right? All the economic textbooks will explain that, all the economic formulas will explain that to you. It's just, I used a James Bond analogy back to explain it to people. There was a movie called GoldenEye, and Alan Cummings, very young Alan Cummings in those days, played an annoying Russian programmer who thought he was sort of the bee's knees. And at the end of a classic James Bond movie, everything's blowing up, and Alan Cummings looks around and he's survived and he's totally amazed, and he stands up and he screams, I'm invincible. And unfortunately what he forgets is the liquid nitrogen tanks are behind him, and they rupture and freeze him, and he becomes a popsicle. And I think that was the point. We got to the beginning of this year, we looked at 400, almost 500 basis points of rate hikes. We turned around and said, well, employment still looks solid, and ISM numbers still look pretty good. The manufacturing and the PMIs. We are invincible, and we're just forgetting that it works with a lag. And when you look at the sort of typical drivers of a recession, I think we have a very classic recession coming, in the sense that I think many of your viewers, you're a lot younger than me, so maybe 08, 09 was one of your first sort of adult recession. Key to think that that's the norm. Well, thank goodness it isn't the norm. That was a really extraordinarily ugly recession. And I think we've got a normal communal garden recession, but it doesn't mean it's painless. They're still quite nasty. So what drives this recession? I think actually we have a trifecta of factors driving this. The first one is, I think we have an inventory cycle. So an inventory cycle, and actually probably quite a powerful one, because we have over-ordered inventory because of COVID. We moved from what was referred to as just-in-time inventory, where firms were so streamlined. I mean, you probably went and did your MBA, and half the thing that these kids do, in their MBA is, and you've got tons of MIT MBAs and Harvard MBAs optimizing the supply chain, so that literally the worker reaches behind, he needs that bolt, and the bolt is just there, just one, just as he needs it, right there, no more, no less, perfectly timed. Well, of course, COVID screwed that up. So we ordered a big pile of bolts, right? Fine, as long as the demand is there that the guy can keep taking. But if we've ordered them all and the demand starts to wane, we have a problem. And demand is beginning to show signs of waning. So we have lots of inventory and demand is starting to fall, particularly on the retail side. And the reason for that is that US companies have been highly effective at jacking up prices to the point that they've taken all the stimulus, all the wage increases, essentially away from the worker. And it means that workers can no longer afford more units of production, they can afford less. And so now we're running into this mismatch between what we have ordered, what we have on the shelves, and what we actually need to produce. And that resultant reduction in production is going to cause an inventory cycle. They tend to be quite vicious, okay? And this one could be, I think, quite large. Secondly, I think we have a construction activity slowdown. In the same way, we overbuilt houses in the wrong place. We had a 40+% rise in new home starts since the summer of COVID to accommodate the Great Migration. And those houses are just beginning to hit the market. We're just beginning to see, if you looked at JOLTS data, construction employment is dropping quite hard. That tends to lead the activity. I think we're going to get a drop there. Construction is a very important metric for the broad economy. And then thirdly, we've got this credit crunch. And even before the regional banks, we were looking at a recessionary credit crunch. We don't have that much clarity yet as to how events, which really only started last month, in March, have truly impacted the credit metric. We have some early indications, and those early indications are not good. So I think you have this trifecta, and I think it's a true recessionary outcome.
Yeah, I appreciate all of this, Julian. I think that we basically just got the 101 in what causes a garden variety recession. And I think that going into all of this detail is really important, because to your earlier point, there's so many different, confluence. It's a confluence of factors and of inputs here that are contributing to the economic reality that we're facing today, whether we're talking
Correct.
macro or micro. And I think that's really important to take into account. But it is also important to have that big picture context of the fact that this isn't 2008. That's a good thing. It doesn't mean it's going to be painless, but we have to, have our dose of reality here, right? That's important.
Correct.
Now, one thing that you mentioned here just now, this idea of the credit crunch, this has certainly been one of the topics that I think is taking up the most oxygen, and necessarily so for investors who might be listening to this podcast in particular. the banking crises that we've seen over the last 2 months have certainly been, I think, part of the wake up call for a lot of investors that things are not as they were in 2020 and 2021. We're dealing with a different set of circumstances. We're dealing with kind of the hangover of all of that, overdoing it, to your point, in the
Yep.
early days of COVID. Tell me a little bit more about how the general instability in the banking industry might be impacting the economy in, both the near term and the longer term.
Right. So as I said, I mean, the way that this works, Kinsey, is the Fed raises rates. They start to shift the shape of the yield curve by pushing up short-term interest rates above, say, longer-term interest rates. And banks earn their money the other way around. They want short-term interest rates super low, and they want long-term interest rates super high, so they can earn that difference. So when they start to go the other way, the natural inclination is for credit to start tightening, right? Their margins on bank lending is falling, the risks are rising to banks, so they become more precautionary in their lending. And that's the way it should happen, and that's what was happening pre-SVB. We were already seeing quite a marked deterioration in what banks were telling us they were going to be lending going forward. And that would have already slowed this economy down in the second half of the year. The big imponderable, but I fear is clearly a obvious risk to the downside, is quite what SVB and this ongoing regional bank problem has done. Because there was an interesting paper written, which I read by a guy I have quite a lot of time for, and he went back and he looked at 800 years of banking crises. And we always tend to think it's different this time, and actually it's remarkably similar, right, how the world worked, right? And these are very basic forces that profitability, what it costs you to borrow money, how much you can lend it for, et cetera, et cetera. And he said there's an 80% chance, if you go back and you look in history, that this is a systemic banking crisis. And I tend to agree. And by that I mean this thing can continue to spread and can continue to morph into something worse, because there's really nothing so far that has addressed some of the fundamental issues facing some of these regional banks. And what people need to understand is, sure, maybe the Fed can lend the money short term against some of their existing securities, which are underwater because they haven't marked them to market, right? They're holding them essentially on the book at a loss, right? But that doesn't help, because they're going to be borrowing money at 5% off the Fed. They're earning 3% off these assets. They're losing money on that trade. They might have other assets. We haven't even started the credit side of the problem. So in other words, as unemployment starts to rise, credit card defaults tend to rise, mortgage defaults tend to rise, car loan defaults tend to rise. And that's all coming if we go into recession. Okay, so you've got this bank sitting there that's losing money on the existing assets they've got on the books. They're looking at their existing assets and go, oh my goodness, we may have to start writing some of these down because we're going to start taking losses. And then someone comes in to try and borrow money. And without lending money to people at an increasing rate, or at an increasing level, I should say, you can't grow an economy. Mm-hmm. And in some sectors of the economy, this is going to be a singularly large problem. And we did a piece where we looked back at a credit crunch in the second half of the 1960s. And what was remarkable is how quickly it bit. Once it bit, it was nigh on instant, and I say that in economic terms, right, because things happen over months and years. This credit crunch took employment growth over a 1-year period from plus 400,000 to minus 600,000. Industrial production dropped 10%. GDP dropped 6%, albeit from higher levels than we have at the moment, okay? And things like housing activity dropped in half. So this credit crunches can be really vicious. And I think that's the risk. We were already looking at a slowdown, and the risk is that these regional bank problems, if we can't solve them, they're very hard to solve. They're not easy, right? Unless the Fed slashes rates tomorrow, which they aren't going to do, right? Unless we recapitalize the banks, these regional banks, which we aren't going to do, these guys' natural inclination will be to shrink lending on an ongoing basis, and that's a big problem.
Right. And if, with all of this in mind, this does become a systemic problem that is, to your point, potentially very likely to happen, whose responsibility is it to fix this? I think that's the natural inclination for a lot of people, is to wonder, well, if this is the reality, how do we get to a different reality where there isn't a credit crunch, or
Well, I
where,
mean, ultimately, there's various different things you can fix, right? So when you look at deposit guarantee, it's Congress. Oh dear, really? We're going to have to rely on that, shower of individuals to fix this. Not with any speed, I'm afraid.
right.
Particularly when they're haggling over debt ceilings and various other things, right? I think that puts probably more pressure on the Fed to do more, which they are going to really not want to do, because how do you do it? You re-stimulate the cycle again, and without maybe wringing inflation truly out of the system. I mean, this is how we ended up building the inflation in the 60s and into the 70s, was a series of inadvertent, unintended, but necessary policy errors that meant that we never quite killed the inflation impulse. It was kind of always hanging in the background. So yeah, the economy slowed and it came back down again. And then we had to flip again and pivot, to use the current parlance, and up it rips again. And that's what I'm afraid we're ultimately going to end up. I don't think it's the issue that we have to focus on right here, right now. But yeah, I mean, it's going to be policymakers are going to have to do it. Otherwise, these banks are going to steadily erode, at very least in their lending, and many of them will not exist. And suddenly when you take, a $50 billion bank, right, and you multiply that, 10 times over or 20 times over, remember we've got thousands of these banks, right? All of a sudden you're starting to talk real money to really certain key sectors of the economy.
Yeah. And, all of this in mind, Julian, it makes me wonder about how, we consider what's going on in Congress, that aspect of how we might rein in an economic situation like this, the fiscal crises that are happening on a regular basis. We're talking about the debt ceiling, major, roadblocks and gridlock in Congress in terms of figuring out how that gets solved. At the same
Yep.
time, there's been a lot of talk among investors and among even just, everyday regular people about how the Fed is acting, the monetary policy aspects that the Fed is responsible for, whether or not it's working, whether or not it's working fast enough. To your point before, will there even be a landing, let alone a soft landing, to rein in inflation, but without sending us into a recession? Do you think that this erodes trust from everyday people in the systems that are supposed to solve for these problems? I'm just curious to hear your perspective on the more emotional aspects of this.
I think it's a very poignant question, to be honest, because I think this is one of my bigger concerns. I mean, it is an erosion of trust in the system that very much led to the events that we had in the sort of 60s and 70s. It was around politics. It was around fighting a war in Vietnam. It was about post-war change. It was about a new generation of kids that were coming, to being politically active, and wanted a very significant change from their very sort of stiff, conformist parents' generation, right? And I think that's exactly it. I think that leads to political volatility. I think all of these factors, and this is why actually the world is not really ever that different, right? We go through these societal swings and roundabouts, right? People age, they get too conservative, the kids come along, they rebel, they want different things, we fight wars, we don't fight wars, right? All of these things have happened in a myriad of different times throughout history. And I think it's arrogant and rather presumptuous to assume that we're doing it for the first time. Right? I mean, goodness gracious, I look at my daughter and the clothes she's wearing, and I'm like, oh my God, I used to, my friends wore those in the 70s, right? I mean, literally, flares are back. I'm like, that's it, big recession, because that's what we wore in the last big recession, right? So, it's never different. But you raise, I think, an interesting point, and it leads to political volatility, because if Biden doesn't achieve it, we'll vote in a Republican, and can the Republicans really solve it? And the answer is not easily, right? So then you throw them out and you bring back the Democrats, and you tend to become increasingly aggressive in the pursuit of certain policies. So policies become more and more to the extremes, and that's taken to its nth degree. And I don't think we're going there. Bloody hope we're not going there. That's when you end up with people like Adolf Hitler, right? Because you come out of deep depressions and no one else has an answer, so you vote in an extremist.
Yeah. And, again, not to get political, but I think that especially in just objectively speaking, the reality in the United States right now, we already are in a fraught situation with our politics.
Correct.
And with the people and the parties and the ideas that we vote for. And I think pairing this with a recession, not to sound too alarmist, I think is certainly something that is going to be impactful for investors, for everyday Americans. And I would love to close this conversation by getting your perspective on the investor idea right here.
Right.
A lot of the people who are listening to this are retail investors themselves. And I'm curious to hear how we should be interpreting all of this uncertainty and what might come next, being honestly a big fat question mark. What would you say to the investors who are listening to this, who are trying to figure out what their strategy should be moving into the next 3, 6, 12 months?
So look, if I look at my own sort of portfolio, I am, long some stocks, not many in the US increasingly. I'm increasingly trying to diverge my risk-taking position outside the US. And in fact, because I just think US stocks have had a 10-year run. I think we've had a great run of broad outperformance, and I doubt that's going to continue. And I think in part that's because I think the dollar is going to start probably weakening. Can I definitely say it's right here, right now? No, but that's kind of how I'm inching. And in an environment where the dollar underperforms, overseas assets tend to outperform for US investors in absolute terms. Now, I use that word absolute, and that's the key bit right here, right now, because you can have periods in this interchange, and you're going through these sort of recessionary, non-recessionary kind of factors where you get relative outperformance. So that means that, European stocks could outperform in dollar terms for a US investor, but it might be because they only fall 5% and US stocks fall 20%, right? So you've got to be quite careful. So I'm a more sophisticated investor, so I tend to be long certain things and short other things. But I am allocating increasingly overseas. I am holding a decent amount of cash in up to 1 year treasuries. I think, the yields are pretty damn attractive, actually, right, in an uncertain world. And I own precious metals, and I'm starting to own slowly in weakness. I want to build some more industrial type commodities. So some oil exposure, some industrial metals exposure. But I'm being slow on that because I think we're going to be in a recession, and those don't particularly perform well in a recession.
All right. Well, certainly a solid strategy, Julian. And I think that, this conversation has brought to light a lot of the bigger picture conversations that we tend to have about recessions, to the point that I made at the very beginning. There's been a lot of conversation around what starts them, what happens during them, and what ends them. And I really appreciate you taking the time to walk us through all of those. This has been such an insightful conversation. I'm really grateful for all of your perspective.
My pleasure.
Thank you. Thank you once again to everybody out there listening, and to our fantastic guest, Julian Brigden, co-founder of Macro Intelligence 2 Partners. I appreciate you all tuning in, and we will see you next time. Have a good one.